Good afternoon, everybody. I'd like to start by acknowledging the traditional custodians of the land which we all meet today. For myself, I come from the Hawkesbury, which is the land of the Darug and Darkinjung people. I pay my respects to elders past and present and to emerging leaders. This webinar has been a regular feature in the year for us to support members in budgeting. We get asked quite often for a view on where prices are going so that you, our members, can put into your budgets and set expectations on where we think things are heading. We choose this time of year to do it because it gives us the most accurate view based off the back of the large 30 June, 1st of July Australian renewal. And as we've seen over past years, the market continues to change. So we've got some great speakers lined up today to give you an insight as to where we think the market will be for your contribution renewals this year. The thing that I would remind all members is contributions are made up of a combination of rates and asset values. So generally, the speakers today will talk about rate movements, but rate is only one part of your contribution. If your asset values are increasing, that's another part of the equation, but I'll leave that to the team to talk about in there. Before we start, I just thought I'd take the opportunity to give you a quick update on some of the things happening at Uni Mutual. We're now at almost at the three-quarter mark for the year, which is always exciting. In the first half of the year, we've had our member satisfaction survey come through with a score of 97% trust and 100% member satisfaction. So I'm really excited by those numbers, not just because they're great numbers, but honoured that you feel the service we deliver is to your satisfaction and that you trust our advice. So I really appreciate your support of us and to those who completed the survey. Off the back of feedback, we created some chat rooms recently, which enabled some great conversations in underwriting, member services and risk services. And the feedback has been positive about those, and you're looking for more from us. And we'll continue to create that opportunity for members to talk not only with Uni Mutual, but peer-to-peer, leveraging our breadth of membership. Coming up, we've got a new website rolling out in September, and we're all busily working on the content and the look and feel for that. So it's exciting to be able to refresh the website that we have and make it more accessible for our members and make the great content we have more accessible for our members. And finally, as forecast at the half-year update, we are still on track for a small surplus of $2 million this year, which again is a good position to be in to ensure the sustainability of our mutual moving forward. So some exciting news, and as we enter the last quarter of our financial year, still a lot of work to do to deliver for you a smooth and seamless renewal in line with your expectations. The second thing I'd like to talk about is just the concept of pricing. I hear from members sometimes this concern that pricing is community rated at Uni Mutual, meaning that everybody gets the same price or the same rate because we are a portfolio or a community. And I'd like to sort of debunk that myth to some degree. Pricing is a complex thing, and it comes down to your non-catastrophe exposure, the type of occupation, the type of risk that you have, construction of buildings, protection of those buildings, natural catastrophe exposure, and also claims experience. So there are a number of factors that are built into pricing, and I hear sometimes our members are a little bit confused or concerned that everyone gets the same rate. So if you're a better risk than others, you're not getting the benefit of that, and that's absolutely not the case. So I'd like to just reaffirm that to the membership, that we do price based on the quality of risk and the risks that we see. So what we'd like to do going forward is open a discussion around how we might make that more visible, particularly with respect to risk management. And the team is sort of working through some ideas on how we might be able to show some risk pricing impacts of completing or not completing risk recommendations, for example. And that's something over the next couple of years we'd like to approach, but we'd like to engage with the membership in the next 12 months on what that might look like as we go on that journey, and just give a little bit more transparency around that part of the pricing. Last thing I'd like to just highlight is for the second year, we've opened up the Excellence Awards program. We kicked that off last year to recognise great performance around member services, protections, claims provision and risk services. This year we have opened that up again to recognise great work by our members and service providers. We have taken feedback on the application process and streamlined that, and the team have gone through and tried to make it as simple as possible for people to be able to nominate their colleagues, nominate their teams for the great work that you all do. And it's always good for us to be able to sit down and hear the stories and see the evidence of the great work that our members do. So the website says that opens in November, but I'll give you the tip for those. You can get an early start for those on the call today. It's actually open now, so if you wanted to go in and nominate, please feel free to do that. And you know, hopefully in March, when the awards are announced at the conference, we'll see some of you up there receiving awards. But the purpose of today, and the reason you're all here, is to hear not from me, but from our guest speakers. So we have Susie Amos, Principal Affinity Consulting, here today. A lot of you would have been introduced to Susie this time last year at the webinar for the Renewal, and also as a guest speaker for our conference earlier this year. We've also got Tobias Fowler, our Chief Underwriting Officer, and Celinda Sat, our Casualty Underwriter, Senior Casualty Underwriter, here today to talk about the different lines of business that we have. Susie is a principal at Affinity Consulting, an actuary and director based here in the firm's Sydney office. Susie's worked in insurance for the past 20 years, based in Sydney and London. Susie leads Affinity's commercial lines and underwriting agency practice, which is focused on providing strategic portfolio and pricing advice to commercial lines insurers, agencies and mutuals. She has extensive experience in pricing of strategic advice, claims reserving and portfolio management across many commercial lines. Susie provides a market update on commercial lines every 6 months and is here today to share her latest insights with us. So Susie, welcome, and I pass over to you.
Thank you very much. I'm here to give you a bit of an update on the market again. I try to keep my ear close to the ground on what's been happening in terms of rates, claims experience, and also profitability. But one of the things that I think is really clear is that the market cycle is back, and it's a little bit about riding the wave of the insurance industry again. And it's somewhat of a surprise for the industry, I guess, because we've had so many years where we have we haven't really had a market cycle. This slide shares a view of rate index over time, and it goes all the way back to turn of century. And what you can see there, that for about 15 years, it had been very, very sort of muted or flat cycle. There's very little cycle to see there. And we did have a number of things happen over that time. We had the GFC, we had tort reform, and a scattering of events. But actually the impact and the benefit of the tort reform created a lot of value for insurers, and the reserve releases that came off the back of that meant that insurers could manage the cycle without having to substantially increase rates. Now that continued until a scattering of a number of things. So we had Cyclone Debbie, we had COVID, and also globally there was an increase in the number of catastrophes. And on the litigation side, there was sort of an unwind of tort reform and litigation increased. And that really sort of led to the recent hardening of the market that we saw in Australia, and it happened globally as well. So those blue and yellow lines show the global and the Pacific region rate index. Now that hardening of the market happened over the last 5 years, but what we're really seeing now that's peaked. And we're starting to see, we've seen a plateau of it, and there are signs that we're starting to see some rate reduction in some of the segments. So we really are at the peak. So having a look at what that looks like in terms of the commercial premium is quite useful, I think. So if we add up all the different classes of business in Australia and have a look at how that's tracked, it gives an indication on the size of the market and growth of the market over time. Up until 2018, it remained, fairly sort of low level and fairly flat. Then we had 5 odd years of double-digit growth. That has now reduced to below double-digit growth for the FY24 year. That is an estimate that we have put out there, and that's really sort of highlighting that the market has started to flatten. What I think is quite interesting is that when there is that substantial growth that had been happening over the last 5 odd years, that was at the same time as insurers were trying to reduce their exposure and they've reduced their appetite. So the total market actually grew when insurers were trying to reduce exposure. Now we're getting insurers and capacity being quite plentiful, and the market is basically wanting to grow. So as the insurers are trying to grow, the market has started to flatten. So we have an inverse correlation that happens there. But it certainly is quite a bit of a wave that comes through. So I thought it would be good to explore a little bit more of the detail on, well, what are we actually seeing by class of business in terms of premium rate changes over the financial year that has just passed? Well, overall, it is looking at that flat level. Obviously, by class, though, there are some different stories and messages coming through. Property, which is a big part of the commercial lines market, we would say over the FY24 year, it's been flat. At this renewal, it's, you could say it's flat, but there are signs that some accounts and bigger accounts, good performing accounts, are reducing. Really does depend on claims experience and cat exposed areas at an individual level. But we can certainly say that there's flattening, maybe going forward, reduction in that property space. Liability, look, there's low levels of increases still happening there, so it's not quite at the turning point. So a little bit more in terms of turning in terms of the cycle, but low levels, not sort of significant levels of increases. Financial lines classes such as professional indemnity and D&O, that is a class that had turned first and is the first to show significant reductions in rates. When we look at workers' comp and cyber, that's also sort of looking at the flat level. For smaller companies on the BizPack product, we're looking at low sort of digit positive growth. Commercial motor, I guess, is a bit of the standout in the other direction of quite an increase in rates, and that is really heavily driven off some heavy inflation that's been coming through the motor class, quite sort of, I guess, at odds with where the broader inflation statistics have been when you look at ABS stats. And that is, I believe, driven from a combination of changes in vehicle types, so the increase in technology and also increase in the cost of vehicles when they're actually damaged as well. So that sort of almost technology change has actually resulted in quite an increase in the inflation coming through commercial motor class and taken a number of insurers by surprise. So that's what's driving that particular class. I mean, really, it's a combination of capacity available, but then capacity comes in as a result of profitability. So let's take a look at what the profitability has been and what we think it's going to look like for this year. So what I'm showing on the chart here is the insurance trading margin, and also that's the blue bars over the last sort of 10 years. And then we've also got the return on equity, which is the blue dot that you see there. Now, a typical benchmark or target return on equity for insurers is a 15% return on equity level. And you can see that for commercial lines insurers in Australia, if you average through that, it averages sort of close to, below the 5% level. So on average, there certainly has been below target return on equity, and you see a long period from 2015 to 2021 where it has been quite poor. It's really only been in the FY23 year that it's turned around and achieved target, and I think that's made people sort of quite excited and surprised, and that's part of the reason why some of the rates starting to turn. So that profitability is coming through, and possibly a little bit of excitement coming through. But the FY24 year is probably expected to come in on the 15% sort of target level for commercial lines players, and that's sort of off the back of substantial rate rises, but also the catastrophe experience has been a lot more favourable than what it's been historically, and sort of unusually sort of benign, and probably different to what we might expect going forward. So from the FY24 point of view, it's meeting target. We might expect that to continue in FY25. But one thing that we do see is this lagged effect that happens in terms of profitability and then losses. So we saw the rate start to increase in FY19. And on this chart here, you can see that really the profits didn't turn around until FY23. So it took sort of 4 to 5 years for the industry to turn around. And I think you can see the same thing happen when it goes from a hard market to a soft market, that profitability will remain high for a few years, even though rates might be flat to reducing, but there'll be sort of a lagged effect of that particular feature. Let's then take a look then at a more granular level at the class of business and what profitability we think or we've estimated might be reported by the industry. I guess gives you a bit of an indication of the pressures and where rates might go going forward in terms of this assessment. If you looked at this a few years ago, you would not see such a good sort of profitable outlook. A lot of the classes were below target level, but actually here we've got a fairly good outlook happening because of the many years of hardening of market. And so that is obviously sort of driving some of that sort of turning of the market cycle. Property, BizPack and workers' comp are all expected to be above target. Now, property, it doesn't mean that it's been without some of the challenges of inflation and reinsurance rates going up over a number of years. But what we've seen in the last year is that catastrophes have been quite benign, and at the moment we're in sort of a continued period like that. And so that has given us some quite favourable returns. Now, that's not necessarily what you might expect to see going forward, so potentially a little bit of a anomaly. Inflation has continued to be reasonably high for property. Look, it has come back off what it peaked at, which was at the 15% inflation level. Property is now probably more like the 8% level. But what I would call out in the claims experience and what insurers are seeing is a higher level of inflation than what you would see if you look at typical CPI, or even if you look at building and repairer inflation costs. And that's because there's other sort of drivers that are coming through claims portfolios. We get delays or a lagged effect of improvement in inflation. It takes time for that to come through portfolios, so we're still waiting to see that play out. And also we've got other features such as technology, supply chain issues that are actually impacting insurers a bit more than what you see when you look at the broader economic statistics. Commercial motor is definitely one that's it's got those challenges, but still expecting to see within a target range, within the 10 to 15% target range, because the rates that are being pushed through seem to be enough to cover that inflation. But I guess the question is, how much longer can rates keep going up? There's a bit of uncertainty where inflation might go, and there's a bit of a mixture, but I still think that there'll be quite high inflation in commercial motor, and I'm definitely hearing over the 10% level, potentially to the 15% level. So that's quite elevated. Professional lines is one that has come back in terms of profitability, and that's really because it's been the first to turn in terms of softening of the market. So rates have come down, and so that's reduced our expectations in terms of profitability. There are some early indications of new areas of litigation that are coming out, such as ESG, greenwashing, employment practices, liability type claims that are early days in terms of playing out, but there's some new areas and indicators of claims costs that may resulting in a bit of pressure for professional lines. But you know, all in all, it's a bit uncertain at this stage. Liability is the one that's really the only one below target, heavily driven off a couple of areas. One, the abuse claims, that there's a legacy effect happening in particular segments of the market that continues to increase in the number of claims and actually the amounts that are going to civil liability. But some other areas that have shown more elevated claims costs are around things like psychological claims of coming through a bit more regularly. There's worker injuries that are hitting the liability class, and there's particular areas that are seeing sort of higher litigation and sort of a general level of social inflation at a moderate level coming through. So inflation for liability, it's a bit higher than what we normally expect, maybe at the 6% level. So it's not sort of skyrocketing, but it's sort of at a moderate level. Talking about a different type of cycle, we've got climate, and the two main things I wanted to talk about with climate is, one is, well, what's the current state of the climate? And we talk about the ENSO cycle and where we are. That can heavily impact the claims environment and impact where the insurance market and how they respond. So we're currently in a ENSO neutral cycle, but we're on a La Nina watch. And so La Nina is where we need to watch for flood, cyclone and storm, because heavy rainfall. So if that plays out over the next year, that will probably sort of slow down some of the softening, because it'll create impact on the claim side. In terms of the climate change question and how insurers are responding to this, well, one element is around insurers trying to support the getting to net zero, and so there's more being done by insurers to assist with understanding what the risk is for individual insureds, for looking at different investments or insuring different portfolios that are supportive of climate change. And there's also some new rules coming out in terms of disclosures as well. So the banks have had to report. The insurers now are going to have to go down a reporting path. So it's really sort of starting to move towards being quite transparent about climate change and what insurers are actually doing in that space. So this is, over the next couple of years, there will be a lot of activity happening in the area. Technology is another big investment area that insurers and the broader insurance market is investing in. definitely a technology transformation happening, and it's happening in the translation of information from customers to brokers to the insurers. And it's trying to meet customer needs, to be more efficient, to be more transparent, and to be quicker in terms of responding to questions, claims, and issues. And that's certainly an area that the newer players have been quite focused on, and agile in improving technology. And I think one of the key things that have been coming out of that is the improvement in data and data flow. And so that's something to really be aware for Uni Mutual and members, that the broader insurance market has really, there's been an uplift in that side, and that's an area to continue to invest in, and the importance of data quality will really play into managing the business well, and also getting the best sort of renewal terms from reinsurers. So if we think about, and to finish off my session, I wanted to just put into context, well, what does it mean for mutuals and the market cycle? Because I've talked a lot about the state of the broader insurance market. What does that really mean for mutuals and members? And so I tried to think about it from the membership perspective. And these are the key things that I wanted to call out. That while we're in we've gone through quite a hardening of the cycle from the insurance market, and it's started to go into a softening. I think the insurance market, we can expect that to go back into a normal cycle, rather than sort of the really flat level that we could see in the first part of my slide. But what I wanted to say from a mutual side, they're not as driven by the broader insurance cycle, because they're locally sort of managed. It's really sort of a bit more driven off the reinsurance market, which doesn't make up the full amount of what drives mutuals. So I'd sort of say, yes, there is an element of having influence or being impacted by the broader insurance cycle, but it is muted. And it's muted because your contributions are based on the claims experience and the reinsurance cost. So it's really sort of more heavily driven off the reinsurance market. So when we look at the reinsurance market and how that's been unfolding at this renewal, it has been fairly orderly after a number of years of quite sort of chaotic renewals, and it is sort of behaving similar to the insurance market. So we are seeing similar trends of flattening for property and low level digits for the casualty players. There's more capacity around, and there's a bit more sort of certainty in terms of getting cover. So that's a really positive sign. From the claims experience side, though, it's still quite a feature that comes through the renewal terms. Positive claims experience or poor claims experience will definitely sort of drive the pricing. Data accuracy, I'd call out, becomes important for mutuals to sort of make sure that it continues to improve, to keep up with the improvements that are happening from the rest of the market. And so better data accuracy means that more confidence can be placed in exposures and the terms, and then the terms that you get, there's more confidence in terms of the cover and in terms of the pricing that you can get. And then in terms of the last thing I wanted to just call out, though, is in terms of the contributions or the premiums that mutuals are looking at, and the approaches for allocation of contributions to members. I'm certainly seeing a change more towards claims experience and risk-based allocation. So moving more towards the pricing side, like the insurance market, how the insurance market prices. Now that's certainly not going all the way there, but a bit more of a tilt towards the risk pricing side. So with the contributions and the approaches for recognising improved risk or recognising different exposures, there's certainly been a number of features of renewing, enhancing, and sort of continuing improving those particular allocation models and the pricing that members are getting. So that was the summary of the market. I think it's sort of fairly good and orderly terms that are out there. Might expect it for a couple of years to come, but in total for mutual and members, you should expect the hardening market didn't go up as much for members as it would for the broader market, and I think a similar sort of level of muted cycle should be expected from those in the mutuals membership. So I might finish there, and I believe I pass on to Tobias.
Yes, thank you, Susie. And welcome from my side as well. So we're now just bringing it a bit closer to home. So from the market view, which was just presented by Susie, to more what does it mean for Uni Mutual and where we are in the process from the renewal cycle. If we start with the property, I just want to. So we currently just want to highlight the importance of reinsurance again for Uni Mutual. Not just for Uni Mutual. I mean, reinsurance is important for pretty much every insurer, and that's for just an industry feature. It provides a significant source of capital for insurers, but also takes out the volatility and provides more stability to the insurance companies. Uni Mutual, we use a solid panel of local and international markets to put our reinsurance panel together, which allows us to put a competitive as well as a well-rated panel together for our members. Having said that, it's about 80% of our panel is dominated by the local insurance market. As I put here on the slide, I had a look at a couple of market reports from the major broking houses internationally as well as locally in terms of where the reinsurance market is. And if we start at the beginning of the year, it started with after very turbulent years. January 1st renewals were described as orderly, disciplined, or smooth. If you move 6 months down the track to the July 1st renewals, the feedback shifted basically to favorable. And if that continues, that should work quite well for us at the Mutual. Bear in mind, our reinsurance renewal is the 1st of October, so 4 weeks ahead of the membership renewal. So it is a dynamic market, and where we in the process at the moment, we started presenting to all of our reinsurance markets, and the feedback remains consistently positive from the markets. They like the structure, what we bring to the market. They like the fact that the Mutual has some skin in the game and keep a solid retention. They like the portfolio, the scale, the risk profile, and it's been well performing in the last couple of years. So putting that all together, there was definitely an increased interest in our portfolio from existing markets as well as from new markets that want to be part of Uni Mutual. During the presentations, we obviously highlighted our view on the higher education or the university space in Australia, as well as the challenges that our members face at the moment, and just to bring the awareness and to provide some more insight into the sector. In terms of the questions or what remains on the radar for our reinsurers and insurers valuations, I think that is something, Susie mentioned it, every reinsurer keeps a close eye on valuations in terms of the timing as well as the accuracy. Susie mentioned the difference between building cost inflation as well as CPI. I just put in a few numbers. I think as of March, the CPI was running at 3.6 and building cost at 6.6. So there's a difference between the CPI, and we expect, as well as our partners expect, that's reflected in updated values. Natural catastrophe exposure, it is something that has been on the radar for a number of years and will remain, particularly for the global reinsurers, and that's overlaid with the climate change discussion that goes on. It was really well received, the work we did with Guy Carp and Risk Frontiers on the climate change side, and the climate reports we provided to our members. Data quality is still key, particularly when modeling natural catastrophe events like flood. So just a general comment, this year we need to continuously improve our data to reflect the portfolio the best we can for our reinsurance partners and for the mutual. Claims history, particular development, I think that's something reinsurers always keep an eye on, and we as well, so make sure that we get early on a good view where, if a member has a claim, where these claims are heading. High value equipment, we started that project last year in terms of keeping track of high value equipment amongst the membership, and particularly valuations, how they're valued. We recognize it's not an easy task, and it's a process, but Simon and his team are there to support you in terms of assessing high value equipment, because we've seen a number of losses in that space, so definitely something we need to keep a close eye on. And lastly, risk recommendations were discussed quite lengthy, and it's a couple of points to mention. Is a change in the nature of the surveys we do, sort of going away from the traditional fire focus to broader perils, around Nat Cat in particular. Always looking for continuous improvement. So doing the risk survey and recommendations is one thing, but what do the members actually do? Do they take them on board? And we like to see improvement on not just most recent, but sort of all recommendations that are out there. And it's really a separating factor for us from the market. In terms of claims, it's really important. Lessons learned, what we always call, and I think it's great that we have these webinars and forums where we can share loss experiences and also lessons within the broader membership. Moving on to the actual protection. If we start with the property protection wording, just as a general, so what's driving wording changes in general? There's probably three areas worth mentioning. Losses trends is anything where we need to react, or where the insurance industry needs to react to loss trends, or particularly exposures. Can be reinsurance requirements that they put certain requirements onto the reinsurance wording that has to be passed on to the insureds. And these are factors that are common in the insurance industry. They would impact Unimutual as well as every other insurer in the market. What does separate us, the third point I wanted to mention, which is quite unique for a mutual, is member feedback. And that's really something that we take on board. And we had a couple of smaller changes this year on the property side, where a member brought us to our attention. There've been to be some areas to be tweaked. So generally on the property side, there's a couple of minor changes, nothing significant, but mainly improvements or clarifications. On the terrorism side, we have the we changed or adjusted the terrorism event definition to provide a bit more clarity, particularly in how it interacts with some of the exclusionary wording that's used in the terrorism protection. For the upcoming renewal this year, accuracy and timeliness evaluations we talked about, they remain absolutely critical, and particularly the members who don't have any updated valuation, the sort of the desktop valuation or indexation, can only really encourage members to think about what reflects best the increase in building cost or expected claims. And that also hopefully provides you with no surprises when the next on-site valuation comes on. I think Jeff mentioned before what contribution changes are not just rate changes. What goes in there, value updates, data quality, new assets, updated the value of existing assets, and the rate change, as well as the loss history. So where does it all end up? To provide a bit of a guidance, we see obviously the rate stabilizing with definitely reductions possible from a rating perspective. So to put a conservative number at this stage around it, we'll probably point it to 0 to -2.5%, maybe from a conservative perspective. It is a dynamic market, and we hope that we can do better than that. But at this stage, that's probably the guidance we put around, and that's on a rating basis. So obviously, if you get significant increases in values, that has to be taken into account when looking at the overall contribution changes in dollars terms. And that's it for the property side. And I'll pass on to Celinda to provide some comments on where the combined liability and the other protections are heading.
Good afternoon, everyone. So my first update would be in regards to the combined liability, the limit of liability, retention for the general and product liability, the professional liability, malpractice and clinical trials will remain unchanged. With sexual molestation cover, we are in negotiation to ensure that the cover will remain as per expiry at $10 million per member. The coronavirus exclusion and cyber and data exclusion also to remain as per expiry. There are a couple of new endorsements that may apply at renewal. We are still in discussion on these three endorsements. The first one is social engineering exclusion that may apply under the professional liability. And do note the social engineering cover is available under your management liability policy with Unimutual only if you purchase a full crime cover. The second endorsement is misconduct exclusion. Again, this exclusion may apply under your professional liability. The intent of this endorsement is to exclude any employment practices liability claims. Employment practices liability cover, again, is available under your management liability policy with Unimutual, but only if you have an employment practice liability cover. And the third one is latent injury. So this cover may change from occurrence-based to claims-made. The retro date may be inception, and the limit will be 30 mil and in the aggregate. We are in discussions with our reinsurers on the three potential endorsements. We will advise our members if this endorsement need to apply at renewal. Our current read is that all things being equal, most members will see their contributions rollover or a single-digit increases subject to individual member loss or claims history. And we'll go to the next slide for management liability. So the new management liability policy wording was released last year at 2023 renewal. So the directors and officers liability, employment practices liability, crime, kidnap, ransom, and extortion coverage section will remain unchanged. The limit of liability, sublimits, and deductible on all coverage section will remain as per expiry. All current endorsement will remain as per expiry. So due to the new wording last year, we introduced the difference in condition and difference in limit endorsement. That was to ensure there are no gaps in cover for the first 12 months only. So this endorsement will not be available at this renewal. Again, in terms of contribution, we're expecting a rollover and a single figure increases, again subject to individual members' loss or claims history. And the next one, we're going to go into cyber. So the updated cyber protection was released in 2023, which include several coverage enhancements like contingent BI, system failure, betterment, breaking, and etc. So it remains market leading coverage. At the same time, we also offered discounted pre-loss services as a value add. So there will be no changes in coverage, limit of liability, or the retention. So in respect of the ransomware, the approach to ransomware cover will remain the same for this renewal. Members that want more than 5 mil of cover will be required to have the same mandatory controls that were required last year. So there is the following new endorsement that will be added at renewal. The first one is claims protocol. Clyde & Co. will replace Crawford as the incident response manager. The second endorsement would be emergency assistant costs. This means basically the retention will not apply to breach response costs incurred with recommended vendors in the first 24 hours, provided Clyde & Co. are notified of the incident within 48 hours of the member first becoming aware of the incident. The third endorsement is extortion expenses. The economic test requirement has been removed. The next one is war and cyber operation exclusion. So in line with market practice, this will replace the standard war exclusion in the current wording. There are many different versions of this new exclusion in the market, with some being much broader than others. The Unimutual version is more favorable to our members than many of the versions in the market. And the last one is the sanction condition. Updated version will be applied, but no change in intent or cover. My next point is in terms of the renewal pricing, it's too early to provide accurate guidance on renewal pricing, but we are aware that AXA will be very focused on assessing your IT security controls and will be individually underwrite each member to determine a fair contribution based on that assessment. So many things can happen between now and renewal. And a prime, I think, example is the CrowdStrike outage. I would like to add, if members have been impacted by the CrowdStrike outage, which was not caused by a cyber attack, they may be entitled to cover under Protection Agreement 2.8, which is dependent system failure, business interruption loss, and also Protection Agreement 2.11, system failure, business interruption loss. So some members may have been impacted and may not be aware that your cyber protection covers this. Please contact me directly should you wish to have a further discussion. And that's it from me, and over to you, Christine. Thank you.
Thanks very much, Celinda. And Tobias, can you flip to the next slide? I'll just go through the next steps with regards to the renewal process. So at the moment, thank you to everybody who is working very hard in putting together their data collection information, which is due to be completed by the 31st of July, which is only 7 days away. If you need any assistance or have any questions about this, please get in contact with us. The data collection information also includes the updated COPE information, so if you can get that to us, and we can assist you with getting that into the system. We aim to have renewal quotations available from the 8th of October, and we'll also be doing our regular renewal presentations commencing the 9th of October to all the members, as we've done in the last couple of years. After that, the members will confirm the acceptance of their preferred quote options. This is required by the 28th of October. And once you have confirmed renewal, we can then issue the confirmation of protections after that time. And then there's the offer of membership, which is issued for final sign-off. We'll be then issuing the certificates of entry and invoices on the 1st of November. We will be requiring payment as normal is due by the 30th of November. So that's the steps that we're going to take throughout the renewal process.